Hello everyone. Today I'd like to share with you an important topic in international finance, the euro dollar market, how it works and how it affects the interest rates and why it matters for financial integration. This is our group member, Xiangsheng, Zhang JIARUI, YIZHE, 范逸轩, Ning ZIJIE, and first part is about the introduction.
Okay, hello everyone. Today we will talk about international financing markets. These markets help move money across countries. Banks now lend money to people in other countries. For example, the Europe dollars market lets banks use US dollars outside the US. This contests interest rates between countries, but also spreads financing risks. Governments and companies raise money by selling bonds and stocks. People can invest from anywhere. This helps money go where it's needed. But if one market crisis, others may follow, who also have derivatives like openers and futures. They help investors reduce risk. Their use has grown a lot in the past 30 years. Now, big loans are often shared by many banks. They are called syndicated loans, which reduce risks and increase lending. In short, finance markets are global first and deeply connected. Okay, thank you. Next page.
Okay, the next part is part two, the operation, measurements, and significance of the euro dollar markets. First, the definition of the origin of the dollar market is a key fantasy innovation about enable US dollar to cruciate outside and regulator reach of the US further the service in this market. Banks outside of the US accept dollars deposit and lend them globally. This transaction occurs beyond US brands and therefore they are not subject to US such as reserve the requirements of the deposit insurance. The origin of the euro-dollar market can be tracked back to the post-World War II era as the global trade inspired and the demand for a natural, widely expected reserve crucial growth. The US dollar back to the strong institution and economic stability because the dominant medium for international placement its role was future reinforced by the fact that it was and still is the dominant the currency for the commodity, the pricing and global trade contracts. And also the history, development, and how the market works is significant too. The system formally began during the Cold War when the Soviet Union started. Deposit is a dollar reserve in Britain banks to avoid the petrol the US assets of reasons. This created a culture where US dollar will hold outside of the country, free from the US capital controls. By the 1960s, difference between US domestic interest rates controls and higher Australian yields made Europe dollar deposit very activity. Regulation Q, for example, capped the interest rates on US domestic deposit, promoting the capital to flow Australians by the 1970s. Oil exporting countries began deposit large dollars supplies in the Europe dollar systems. Although the name strikes the Europe focus by the 1980s, the Europe dollar market has expanded well beyond Europe, include Asia, the Caribbean, and Middle East. Euro dollars are created when US dollars are deposited in the bank outside the United States. It's also due to the international trade or investment. For instance, if a US exporter is paid in dollars by a German importer, the fund may be deposited in a London bank to finance future trade. This London basis dollar deposit becomes the part of the euro dollar systems. Unlike the domestic US bank deposits, Eurodollars are not insured by the FDIC and they are backed by US reserves requirements. This significantly lowers the opportunities cost for banks and makes Eurodollar loans cheaper for global borrowers. Also, the Eurodollar market is closely linked to the concept of the carried interest private differential between the two countries should be equal to the forward premium or the discount in their currencies. In mathematical terms, you can see from the right side, the Euro dollars, it means the arbitrage opportunities are eliminated when carried forward contracts are used. The Euro dollar market facilitates this process by providing offshores access to the US dollar interest rates and forward countries. According to the Alexander Schroeder, and this market is attractive for risk-averse investors due to its liquidity and depth and resilience. One of the most profound implications of the Eurodollar market is its role in transmitting US monetary policy globally. When the Federal Reserve adjusts its interest rates, which changes quickly affect the Eurodollar lending rates, which is turn impacts the domestic financing conditions in both energies and developing economics. So, in summary, the Eurodollar market is foundation element of the global financing. It supports trade and investment by enhancing US dollar liquidity and worldwide, but it also limits the national policy autonomy and heightens the systemic risk. Understanding this market helps us better grasp how financial globalization works and where its valuability lies. Okay, next part.
This part of my work involves literature review. We summarize the three key points from the literature we examined. The first point is that Eurodollars are essentially non-institutionalized because Eurodollar are not directly subject to the direct supervision of the US Federal Reserve System. This is to say, they are not bound with US laws. Banks individuals can use these dollars from various financial operations, such as lending without meeting the legal regulatory requirements of US mainland. The second point is the Eurodollars are of the mixed nature because it cannot be established by any official institution or country. It is merely a product of the development of the times. This is the naturally formed market system. From this perspective of the legal regulation, it is mixed because different regions have different regulatory system for the European dollars. And the last point is infrastructural entanglements between states and provide financial actors are a core feature of the monetary system. Because the operation of the monetary system relies not only on national sovereignty and institutional support, but also highly on private financial institutions as providers and executors of the infrastructure. Okay, next page.
Okay, for right now, let me talk to you about the policy implication and risk case. So the Eurodollar market fuels global finance, but its offshore nature creates unique risks. The first one is regulatory gaps. Transactions occur outside any single jurisdiction. We need stronger coordination between central banks to prevent arbitrage. For the second is spillover effect. The favorite hex waves with the Eurodollar rates, disrupting capital flow and limiting other central banks' independence. For the third is corrugation risks. In 2008, the market froze overnight. Banks reliance on short-term funding makes them vulnerable to liquidity shocks. For the first is leverage danger, where useful for handling OTC contract can amplify crisis. So we need to get some solution. We get the three solutions. For the first is global standard for transparency. For the third is stress test for bank Eurodollar exposure. For the third is central cleaning for derivative. Okay, that's all for my part.
Okay, Let me summarize about the euro-dollar market. This market allows people and business around the world to use US dollars outside the United States. It has grown meaning because of financial rules in some countries and the global needs for US dollar funding. The euro dollar market helps improve global financial efficiency and support international trade and investment. However, it also brings certain risks. Because it operates outside normal regulations, problems in this market can affect other countries, as we saw during the 2008 financial crisis. To reduce these risks, countries should work more closely together. There should be better transparency, stronger rules, and better systems to manage risks. In the end, keeping a balance between financial growth and financial safety is a key for the stable global economic. That's all for our group presentation. Thank you.